Hello, and welcome to the LA Venture Podcast. This is Minnie Ingersoll, host of the podcast and partner at 10110. 10110 is a seed stage fund here in LA. All opinions expressed on this show by me and my guests are solely our own. Very excited to have Scott Stanford from ACME on the show today. Before starting ACME, Scott was the co-founder of Sherpa Capital. Scott has made investments in companies you have heard of: Uber, Facebook, LinkedIn, Square, Slack, Robinhood, Palantir. It is a crazy, amazing list. Check out his website, acme.vc. Before starting Sherpa, Scott was the head of global internet investment banking at Goldman Sachs. Scott is yet another great example of all the best people moving to LA. Scott, thanks for coming on the show today.
Thanks for having me. Excited to be here on the show and frankly excited to be in LA.
Great. Maybe you could start with just telling me a little of about ACME and kind of the basics of sort of the evolution from Sherpa to ACME.
Yeah, sure. It's all based on a similar premise, and that is finding opportunities to partner with incredible founders. Everything we look for kind of has disruption at the core. We thrive on disruptive business models. We thrive on disruptive technology. And when the two overlap, that's even more exciting. We're all kind of technologists, geeks at heart. When you look at our individual backgrounds, we've all been doing something in tech for pretty much as long as we've been doing. So we're doing this out of passion. And when we find founders doing something really exciting and disruptive, we get excited. If you look at our website, you mentioned acme.vc. We put something up there recently that had really been just more of an internal thing we used within investment committee, and that is this Dare To challenge, where we would dare each other to get up in front of investment committee and say, okay, dare to imagine X. Dare to imagine turning this segment of the health industry on its head. Dare to imagine putting 250, 300-pound models on the runway in lingerie. Dare to imagine taking a critical technology and infrastructure and 100xing the efficiency and reducing the cost in an equivalent way. And that's when we kind of sit up and get excited. If someone's coming to IC and saying, dare to imagine a cloud optimization software that will shave off 3 basis points and, sure, lots of money for enterprise servers, it's a big yawn. And that's not because those aren't great businesses. It's just, we don't have that DNA. We don't have that experience. We don't even know how to listen to that pitch.
So with that Dare to Imagine lens, do you think that you sort of take more risks, or how do you think about the risks that you will take or won't take when looking at an investment?
That's a great question. And we are early stage investors. And by definition, we are taking more risk than a growth investor. However, this is our 10th fund. If you look at it collectively between Haney and my experience, we've found this kind of place, this calibration point where we're not investing in science projects. You can never de-risk a Series A investment. By definition, half of our investments are going to fail. Mm-hmm. If fewer than half fail, or fewer than like 40% fail, we're not doing our job right, because we're not taking enough risk. Because the way early stage venture works is you have 1 or 2 successes in the portfolio, and that makes the success of the fund.
But you're generally coming in though at a Series A.
So think of it this way: a $3 to $8 million check gets us ideally, approaching kind of double-digit % ownership, depending on the stage. But we underwrite a little bit less on ownership and a little bit less on stage and more on return profile. So we're really trying to see a pretty believable path to a 10x return plus, and being an independent company. We don't play the M&A game. Frankly, that takes us out of a lot of interesting opportunities. Here in LA, I see all kinds of really cool early stage startups, but not surprisingly, given the DNA of LA, is some of them have to do with branding. Like, kind of a corner brand, the next fill in the blank drink, nutrition supplement, whatever. And you can make a lot of money investing in those things. Hard to see the next GNC being built. Hard to see the next Coca-Cola being built. Of course, there are the breakouts, but oftentimes the exits for those companies, if there is an exit, will be an M&A, a couple $100 million M&A. And that's not going to do what we need to do for the economics of our fund.
So do you think that lends you to investing in people who are a little, I don't want to say crazier, that sounds unfair to your founders, but
frankly, we're crazy. So it's the pot calling the kettle black. Like, if you look at what we do on our weekends and our free time, it's what we do during the work day. Like, we are obsessing with technology, we're coding, we're reading. My partner loves Dungeons and Dragons. Like, that's just what we do. And so when we find founders that have that genuine passion, we get really excited.
And is this the same as what you were doing at Sherpa?
Yeah, very similar. We have the entire team, but we've added a bunch of people, added 3 new partners. But it's the kind of core operating team, the back office, everybody is still intact. So from a culture perspective, a team dynamics perspective, it's all the same. We've definitely refined things and focused them. As I mentioned, we had a growth fund in our second vintage. We don't have a growth fund.
So what's the trade-off there? Why did you decide to go that route versus a growth fund?
Well, I mean, it's a virtue out of necessity in so much as, we were raising the first ACME fund, and it's a little hard to go to market saying, hey, everyone, we want to raise, a couple $100 million venture fund and a $500 million growth fund. And they say, well, maybe we should date first.
Fair point.
But the reality is, I'm not sure we will. Like, the drawback of not having a growth fund is you can't just write checks, right? We still have to go around and work with our LPs, educate them on the companies. Now, it requires more work on our part. But when you look at our LP base now versus when I started, we have some incredible institutions, endowments, sovereign funds, pension funds. And these guys are really sophisticated. And not all of them do co-invest, but quite a few do. We're a registered investment advisor. We took that extra step, which most venture capital firms don't. Most VC firms operate as ERAs, exempt reporting advisors. We are regulated by the SEC. So we've got these guys in suits that come in every year and, take a look around and, ask our COO fun questions. And that allows us to be a little more nimble with doing the co-investments and working with our LPs, because we can do work in secondary.
Well, let me stay on that for a second, which is this ACME Fund 1? Sorry.
Oh, geez, don't get me started. When we went out fundraising, we're like, okay, actually, we first called it ACME X, which we thought was clever because it's a variable X, and technically it's our 10th fund. Our LPs looked at us like, what are you talking about? Like, we have no idea what you mean. So we said, okay, it's not really ACME 1 because we have all of the legacy portfolio, from Fund 1 and Fund 2. We have all those portfolio companies, and all the partners have interest, have carry in those funds. So it's really our third fund. We just changed the name, so it's like a name change. So it's technically ACME 3 is the fund we're under.
Okay. I thought it was a simple question. Okay. So, but you still had the chance. Where I was going with this question is you had a chance to sort of rebrand, rethink about things. And so, when you're looking at the VC landscape, did you think about, there are specific things I want to do different or carve out certain differentiation for this fund?
The most important thing is culture and team. Like, if you don't get that right, I don't care how smart you are, how good your strategy is, the wheels are going to come off. And so the big decision that I had to make is, do I go it alone or do I find a co-founder? I thought about it for like 2 seconds, and the answer was I absolutely wanted a co-founder if I could find somebody that had the following, 10 things. And, as I went out and talked to people, I was lucky to find 2 or 3. And the challenge with VC firms is you have these, golden handcuffs, and so much as your carry is 10 years out and you've got like 10-year vesting. Yeah. And so there are people that are in essence trapped in venture firms that don't have very good cultures. They're good people, but their cultures aren't great, and they would leave if they could. I don't want to suggest it's an epidemic, but there are examples of that. And so some of the people that I thought would be great to partner with just weren't available. And then it was actually a founder who's like, "Hey, have you talked to Haney?" And I was like, "God, Haney! I've known Haney for whatever, 10, 15 years. I knew him back when he was at Glue Mobile and I was at Goldman Sachs. And I was like, no, he's at GGV. He built GGV. He was a co-founder of GGV. Like, the guy's a legend. And, he personally was responsible for returning a third of GGV realizations to date. And that number has gone up with DraftKings, obviously. So anyway, long story short, Haney and I connected and it was so fun. Like we got through the hard stuff in about, I remember we scheduled this like 5-hour session. We were in Copenhagen together and we scheduled like a 5-hour hike where we were going to do culture, economics, all the tough stuff that you wring your hands. And I don't think we had gotten to the trailhead and we had figured it all out. And so we spent the next 5 hours, like, just eating food and kicking around. Like, so I knew right away that there was an amazing partner in Haney. He didn't know yet because he was still kind of finding his way, exiting GGV. And so I brought him in. He sat in on investment committee meeting. One of our associates, now a principal, she was going toe to toe with me, disagreeing with, my opinion. And Haney was like, this is unbelievable. I love this. This is what it's really about. A flat culture where everybody's sitting around literally a round table. And it is just a pure kind of meritocracy and intellectual debate. There's no hierarchy. There's no, I'm the partner, you're the whatever, none of that.
Well, I feel like I should ask you about investments. I could ask you a lot about culture, but let me ask you some about, some of the investments maybe that you saw early.
There are a bunch of examples, like early days I spent with Reid Hoffman, or early days at Facebook, like seeing that, oh my God, there's something massive here. And if you go back and look at my notes, I used to call Facebook a data sponge. I was like, this was, whatever, 10, oh God, a long time ago. I didn't want to think about how many years ago, where everyone was talking about it as, a photo sharing platform. Like, no, this is data, especially once they started doing Facebook Connect. So it's those sorts of like early insights that I get super excited about. I'll tell you, one of the traps though, that I've learned is you can't finish the founder's sentences. So when a founder's pitching you, it's so tempting to be like, oh my God, you're right. And if you do that, you can do this, and then pull a 180 and then do this and turn that corner. And the founder goes, And then you walk out of the meeting being like, this founder's amazing. She's going to crush it. And then, a few quarters later, a year later, you're like, what happened to all those other turns? And so it's really got to come from the founder. And it's a long way of saying I don't take credit for these ideas at all. I'm lucky enough to partner with them. And one of the fun stories is the Uber story, because if you, actually, there are a bunch of fun stories about how you meet founders. In Uber's case, I met Travis at a pub in Ireland where we were like eating, I don't know, Irish food, meat pies or something. And I was there with a group of founders that I knew well, but I had never met Travis. And Travis happened to be sitting to my right. And I was like, what do you do? And he gave me some pithy line about how he was taking down the taxi industry. And I was like, thank God somebody needs to. And that led to several beers and then a run in the park. And the run in the park was pretty amusing because I'd gone running and then he came out to run with me and he didn't stop running. And we just kept going around and, it's not a big park, thank goodness, but we just kept going around and around and around and around. I was like, oh my God, this guy's got a lot of stamina. And we hit it off and, I talked about the things, my view of what he was doing. And we made the investment in the Series B and, didn't know who any of the other investors were and just thought the company was super interesting. I remember the investment committee discussions at Goldman were not straightforward at all. There was absolutely difference of opinion, but frankly, some of the best investments that I've ever been a part of and that Haney's ever been a part of are the ones that are the most contentious. So anyway, the Uber one's a fun story. There, you can look in our current portfolio and see some other stories like that of like, how I got to know Marcelo at Ipsy, how we got to know the guys at Q, how I got to know, David at Curology. So
yeah, let me jump. Like, how did you get to know the Q team?
That came through tech, whatever it's called, like an incubation program. And they were doing a demo day. And we had gotten a heads up from our friend who ran the program. And he said, hey, this thing's kind of interesting. And it was two guys who had taken apart a glucose meter in their apartment and said, okay, interesting. There's some things that we could do with this. And their vision was to basically take Quest Labs and put it into this little thing. And, we quickly kind of grabbed them off stage and had a term sheet signed very quickly, and have been with the company since its formation. We were the first capital in, and we brought in Johnson & Johnson. So we introduced J&J to the company. They led the Series B along with us. We brought in basically BARDA, which is a US government agency like the Department of Defense, but for health. That's part of what we do, is just bringing a lot of other people to the party, so to speak. And so that was a fun story of them kind of coming out of the incubator. And there were other people sitting in the audience. There were other venture capitalists who were probably still waiting for those guys to come off stage so they can have their meeting.
That's amazing.
But, Q was just in the news recently. They got a $481 million order from the US government. So that business went from zero revenue, spending a lot of money on science for 6 years, to all of a sudden having over $500 million of revenue.
When you say you get it done fast, how fast do you usually move on deals that you like?
I mean, it depends. We can move extremely fast. We need two partners to make a decision. So if two partners are advocating for an investment, the investment will get done, even if two other partners hate it. And so we rarely, I don't think we've ever had that situation where two partners hate it, because we feel like it's incumbent upon us to at least get the other partners to a neutral position. Because if they hate it, it means they don't understand it, or we don't understand it, one of the two. But if they're neutral, at least they're saying, okay, I hear you and I believe you. So in answer to your question, we could have a term sheet out in a night if we needed to, because we could scramble. Now, the good news is we don't usually need to, because we get the opportunity to spend time with the company, get to know them, kind of work through their process. But I don't think there's been a situation where we've in earnest gone after an investment that we haven't succeeded, except where valuation runs away. And frankly, those are mistakes. Valuation shouldn't be the key determinant of investment in a Series A.
Yeah.
If you're off by a little bit in your Series A, it doesn't matter.
Yeah. So you alluded to this a little with Q. I wanted to ask kind of what's your style? Like, you've seen all sorts of great investors. And I think one of the things you said with Q is you bring in a lot of people around the table. And I don't want to embarrass you, but the Wall Street Journal article said something like Yuri Milner calls you for introductions. It was something awesome. But how do you think about your style once you've made the investment?
It was very kind of Yuri to say that. My mom had never heard of Yuri Milner, but she was really happy to see that article. Although it was a pretty embarrassing article. Look, just on the Yuri point, he and I go way back. I met him when I was in Moscow chasing the Yandex IPO. And I was like, well, where's the rest of the internet? And they're like, oh, this guy named Yuri Milner has bought some internet assets. So I went over and, knocked on his door and said, hey, Mr. Milner, I'm Scott. That led to me saying, wow, you've got a great business here. It was a holding company he called DST, Digital Sky Technologies, and he'd assembled some assets. And so I got Goldman to invest in his firm, and then we became quite close. Goldman, we ultimately took DST public. But then I introduced him to Zuckerberg and introduced him to Facebook, and that's where he met Mark and, really built his franchise. And so he's very kind to say that. I call him for advice, to be clear. So look, we have something that we call IVA. It stands for Impact Value Add. Everyone talks about value add and, we have this network, or we'll give you advice in your board meeting, whatever. We kind of took it to a different level, and we said, no, we would love for the founders to talk about us. This is our goal. It's a very heady goal. Talk about us positively in their memoirs. So we know these companies are not ours. They're not our ideas. We don't take credit for the execution. But if we can help plow the road ahead of them and bring them things like David Bonderman to Uber, then we know we're really doing our job. Because if we're asking a founder, what can we do? Then we're not doing our job. And so, it's easy to get caught up in the moment and be, overwhelmed by all the activity. We've got I think 5 or 6 companies that could be public next year. That alone is just a tremendous amount of work. And yeah, so that's what we call IVA. And we actually have KPIs, and we judge ourselves, we rank. We have a system that says, have you added value this month? And if you haven't, it turns yellow. And if it goes for 2 months, it turns red.
So how do you think about how you spend your time? I mean, if you've got 5 or 6 companies that might go public and you're trying to always be I and V and A-ing, how much of your time do you spend with your portfolio versus looking at new investments versus other things?
I mean, luckily I have a very understanding wife and 2 daughters, because I think like most people, I'm constantly working. And the good news is this is my hobby as well as my profession. So I don't mind working for hours on the weekends on this stuff because it's fun. But the true north for us is making sure that our portfolio companies are thriving. Mm-hmm. What you don't want to do is ignore your portfolio to go fundraise, or ignore your portfolio to go chase the next shiny object.
So talking about your current portfolio, maybe some more, I want to make sure I save a little time to do that.
We should talk about LA.
Talk about LA. Sure. There's so many things I want to talk about, actually. Let's talk about LA for sure.
Let's be clear. I'm loving LA. I'm like, put me on a billboard. I am a huge fan of LA. And this is after, 14 years in San Francisco. I grew up in Indiana. I spent, my undergrad and graduate education on the East Coast. My first job was in New York. So I don't know if I'm ever leaving. The beauty about LA is I can do this job and I can live the life I want to live. Like I have nothing to do with Hollywood. I have nothing to do with what agent is pitching what deal or whatever. And so talk about, a luxury.
Mm-hmm.
When you're in San Francisco, you can't help but to be surrounded by hearing about what you're missing out on. Mm-hmm. And you're like worried. Here, I don't care if I'm missing out on the next, Star Wars, Batman, Superman film, whatever. Like, it doesn't matter. And so that gives you some kind of clarity. But to be clear, there's a great kind of emerging ecosystem, but it's emerging. Mm-hmm. And I get asked this question a lot, like, when I've spoken in different countries and different cities of like, how can fill in the blank be more like Silicon Valley? And, it's you hear different versions of the same story. And that is, it's like a coral reef. It's like a forest. It's like any other ecosystem. You need a bunch of ingredients and then you need time. Mm. And so I do think LA has all the key ingredients. And I do think LA is absolutely trending up, but we've got to be patient and we've got to stay on course. The biggest thing that scares me is politics. Look, California has so much going for it. We all know the stats. I mean, it's the 5th largest country, if it were a country in the world. Trillions, even SoCal alone has over, $1 trillion of GDP. There's a lot of, consumers. So you can test things locally, which is really important. That's one of Israel's hardest challenges is they've got brilliant founders. They've got brilliant universities. They don't have a market. It's a tiny, tiny little market. And so we've got a ton going for us. The thing that makes me nervous is regulatory. Joe Lonsdale published a really thoughtful piece in the Wall Street Journal where he basically said, I'm out. Thanks, California. It's been real, but I'm out. I'm moving my entire firm to Austin. There are a lot of people moving out of California, not just the Bay Area, because either they see the handwriting on the wall or they're worried. And this kind of vilification of success and the additional taxes, and it's just a problem. And we just have to ask ourselves, like, do we want to go down that path? We, California, can make up our own mind of like who we want to be and the relationship we want to have with innovation and with business. And I'm not suggesting it's easy. And I'm not suggesting that everyone doesn't have to make some sacrifices, but we got to get that right.
So there's a very tactical piece, which is taxes. But then how do you think about the role of that vilification piece? Like, because you said this to me, you're like, I want to be anonymous. And I was like, well, could you come on my podcast?
Look, I think politicians or organized government can do more than just taxes, right? There's opportunity zones where you can actually create incentives, and downtown LA was one, or maybe still is one, and those are great. Like that's very positive. Housing, like there's this weird thing in San Francisco where everyone complains there's enough housing, and then there are these crazy zoning laws that allow you to only have something 12 feet high or something like that, so you can't put any high rises up, and then you have this antiquated tax regime on real estate taxes that never change until people sell their house. And so look, there was a joke about anonymity. It's more just kind of who I am. Like I personally love to be, the guy taking the picture. I love to, I find it's the opposite of Schadenfreude. I find pleasure in others' pleasure and others' success. Like that makes me happy to make other people succeed. Is there a word for that? It's a good word. There should be, but if you leave it up to the Germans, they'll only, sorry, I shouldn't say that. Maybe we need to go to like the Spaniards. The Spaniards probably have a word for that because, they're happy. So look, that's kind of who I am, my disposition. I think we all need to make compromises, all of us, everyone around the table. And I am more than willing to make compromises. And I think everyone needs to. And I think we can. And I do think we've got really solid leadership in California. Okay. How do you think things are evolving or going to evolve? Or this has been a huge, crazy year. So much has changed. Yeah. What have you changed your mind on, or has your view of how things are going changed? Honestly, this has been a great opportunity for those that are in innovation, because there's this adoption phenomenon. We call it 5M5, 5 years of adoption in 5 months. So we're investors in Doctor on Demand. That company struggled for a while because people were like, well, this is weird. How can I trust just a set of pixels? I of course I'll go sit in a waiting room for half an hour to go see someone for 5 minutes. That's just the way it's done. I don't think we're going back to that. Right. I don't think anyone's excited to go sit in a waiting room and read Boys Life magazine. That's not how we want to be spending our time. Now we're like, ooh, wait, all this stuff we've been waiting for happened. Now as venture capitalists, we got to cast out another 5 years and say, well, what's that going to look like? Yeah. Now we have some catching up to do, obviously. And so, we have a little bit of time in terms of adoption, but look, the rate of innovation, if you ever read Kurzweil's books, about singularity, he's got a great graph in there about exponential change of innovation. And it is literally a wall. It was like a nice slope with a cotton gin and the printing press and all these cute little mechanization of labor things. But then when you look at the rate of innovation in the last 100 years, it is ramped like this. And in the next 100 years, it's going to collapse down on top of us, basically. Because when we automate thinking, which is AI, it's a complete game changer. Complete game changer. And that's why we've started making investments in companies that, focus on quantum computing. And so I think you're going to hear more about that company, as time progresses here. It's called IonQ. And so, look, our job is to get out in front. Our job is, to cast forward, and it's been made harder by the rapid acceleration. But at the same time, our portfolio companies, for the most part, are thriving. I really hadn't thought about it that way, which is your job is to see 5 years out. But 5 years out, we all are seeing it right now. That's right. Hadn't thought about that. Anything else about ACME or the stuff you've been chewing on for, your vision of things that are going to be big in the next 5 years that you want to share with us? Look, I think we've covered a lot. I think we are going through an interesting phase as humans with technology right now. I mentioned singularity, which we don't need to go there, of the ultimate, merger of technology and humans, which I'm a deep believer in, but we'll talk about that in another podcast. What I think is happening right now is I've been using this term enlightened tech or enlightenment, which is people are realizing that initially tech worked for us and we now are working for tech. And is there a way to kind of find that balance? If you haven't seen The Social Dilemma, it's worth watching. It's very thoughtful, and I totally agree with what they've highlighted. I think there's an opportunity here for us to really harness technology to make our lives better, to free us from the chains of labor, so to speak, as opposed to just replacing us. Mm-hmm. And that's like a pretty existential challenge and opportunity for society. We're right now going through some real growing pains with technology where we haven't seen anything yet. Like there's so much coming that's going to be highly disruptive. And so I really would love to find ways for the innovation discussion to move out of the lab and out of the venture capitalist term sheets and investment memos and into the broader dialogue, not to encourage regulation, because it's going to happen. Like saying stop is not going to work. It's more like, okay, this is coming. We have to deal with it. Pandemic, like there were some people that denied the pandemic, and there are some people that said, I wish I could deny it, but I have to deal with this. And we have to have the same view towards technology. And we're not prepared as a society to have that conversation yet. We're still fearing AI and vilifying, the big bad tech companies that are destroying whatever. Like that's probably not the most healthy approach, because all it's going to do is drive innovation offshore. Because just because we vilify it here doesn't mean it's going to be vilified in China, or that's going to be vilified in Taiwan or in Russia or elsewhere. And so we need to embrace it and own it, as opposed to vilify it.
Right. I mean, it's innovation is kind of a bright spot of our country right now. So you're saying this needs to go outside of, the venture capitalist medium posts into.
We need to bring politicians and thought leaders into that dialogue. And so we've got to find a way to bridge that. And I'm not smart enough to figure that out. And so, I put my head down and I write more term sheets and I find new founders disrupting more big industries, and onward, we push forward. But, I'd welcome that dialogue.
Yeah. Well, it's great. I know we're running out of time, so I want to be respectful there, but I think it's an interesting note to kind of end on and think about. And I'm glad you are continuing to write term sheets and helping your founders. And I'm really glad you're here in LA. I think it's a big win for LA to have you here. So thanks for coming on the show.
Thanks so much, Minnie, for taking time out. And I couldn't be happier being here in LA. And I definitely look forward to finding more ways to be more integrated with the community.